Are there any loans that we can't take subject to? We get this question a lot. And the fact is, there aren't any that you can't take subject to, but there are a couple that you probably shouldn't. And that's what we're going to talk about today on the Sub2Deals Show. Hey, Sub2ers, I'd like to welcome you to this episode of the Sub2Deals Show, where we talk about all things subject to. Today, we're talking about different types of loans and if you should take them subject to. What are the risks involved? What are the great things about some loans, the negatives about some others? There are some different features and some things you need to know. I think the best way to do this is just go down the list of the most common mortgages that you're going to find, tell you a little bit about those, and maybe that'll help explain things a little bit better and help you decide if it's something you want to do. So let's get into that. We're just going to talk about the 6 most common types of mortgages that you're going to run into in your investing. So let's start with the most common, which is a conventional mortgage. Now, what is a conventional mortgage? It's about 2/3 of the marketplace. So it is the most common that you're going to run into. Now, these are mortgages that are not backed by a government agency. FHA, VA, they're not guaranteeing this loans. And because of that, they're going to typically require a larger down payment. It's pretty common to see people with a conventional mortgage put 20% down. They also require a higher credit score to qualify. Even though the paperwork is more streamlined than the government-backed things, they're harder to qualify for. So you have to have a pretty strong credit score and you have to have cash to put down. They're typically fixed rate mortgages, which means that the rate stays the same throughout the amortization, whether they do this thing, which typically the most common is 15 years or 30, but you'll see them in between. I mean, we've seen 10-year, 20-year, so you can set it up really however you want. Is a conventional mortgage a good mortgage for taking over subject to? Absolutely it is. There's no added risk of a due on sale problem or anything else. Most of the ones you're going to run into will have some equity depending on the market situation. Even in a flat market, if they've put a large amount down, they're probably, unless they're in the most distressed situation, going to want some of that back. But is that a mortgage that you can take subject to? Well, absolutely it is. The next is subprime. Now, that's actually what these loans were known as in the 2007, 2008, and so on. And actually, during right before the collapse, subprime mortgages were over 30% of the mortgages that you would find out in the marketplace. Now, a lot of people think they went away with Dodd-Frank and the mortgage meltdown and those things, but they didn't. They're back. Now, they're known now typically as non-prime, which sounds, I guess, more PC than subprime, but that's what they're calling them today. They're generally, you can qualify for these mortgages with a lower credit score and you can have a higher debt to income ratio. They're not quite as stringent. You see a lot of investors getting subprime loans. They have higher interest rates, and you will find them with unusual terms, although Dodd-Frank has removed some of that. But you'll still find loans with things like balloon payments, adjustable rate mortgages, and negative amortizations. And if you don't know what a negative amortization is, that was really common in the early 80s when interest rates were 20%. A negative amortization loan means that you could buy a house for $200,000, and at the end of year 1, you owe $202,000. The end of year 2, you owe $204,000. So you actually went in the hole every month. on what you owed the bank. They couldn't charge you enough interest to make the payment affordable, so they actually had to lend you additional money every month. It was really an interesting time, but negative amortization loans, they do still exist. They're still out there. Can you take subprime loans subject to? Well, yeah, you can, but you just need to know going in what the terms of the note are. If it's an adjustable rate mortgage, I like to figure my absolute worst case scenario. And that is, if this thing maxes out, if I'm at my highest interest rate and I've sold this house to someone with a fixed rate, what is that going to do to my cash flow? Now, if I take over payments today and the interest rate is 4% on my underlying note, but it has the capability to go to 9%, what's that going to do to me? Am I actually going to have an alligator that I have to feed every month, or will I still make money? You also have to factor in time. What you'll see on a lot of adjustable rate notes is that they will have a cap. They'll have a yearly cap, and then they'll have a lifetime cap. So their cap may be 1% per year, 5% over the life of the loan. So if you're looking at a 4% interest rate today, the most it can adjust next year will be 1%. So the most it can go to next year will be 5%. And then the most it can go to over the life of the loan will be 5%. So it's easy to calculate what your worst case scenario would be. We don't like adjustable rate loans because it removes a certain amount of certainty. But can you do it? Yes, if you're very careful in your calculations. You want to make sure you look over those mortgage papers very carefully. And don't be surprised to find out you can be talking to a seller who has no idea they have an adjustable rate mortgage. We actually talked to a seller a couple of weeks ago that has been in forbearance for 18 months. They've owned the house for 18 years. And they just discovered that they've been paying interest only for 18 years. They still owe exactly what they borrowed 18 years ago when they bought the house. And they're in a pretty flat market. We're actually working with them now to try to save their house for them. But, a lot of sellers have no idea the financing, because a lot of people, especially in the subprime market, they go into a situation a lot like rent to own. People that do rent to own furniture or appliances, their main concern is how much down and how much a month. So they're not too financially savvy. They don't know to look over the mortgage payments. And if you've been in a closing before, the attorney shoves paper after paper in front of you. You really don't have a lot of time to read that stuff. But a lot of sellers won't know. So it's going to be your responsibility to look through that paperwork and make sure you understand exactly what the terms of the loan you're taking over may be. So subprime, can you do it? Yes, you can, but make sure that you're fully aware. And part of that information you can get from the lender when you're calling in to verify things. This is a fixed rate mortgage. This is a 360-month amortization. Make sure you ask those questions to verify, but you can take it over. Just know what the worst case scenario would be for you. The next one, FHA loans. FHA loans are government-backed loans with, loose requirements for qualifying. They're typically for middle income, lower income people. You can qualify with a higher debt to income. Some FHA programs actually allow 50% debt to income ratio on the mortgages, which is extremely high. Now, should you put someone in a house that has a 50% debt to income? Well, the government must think it's okay. So I don't know. They come up with some weird things to make people homeowners. Sometimes people that probably shouldn't have that responsibility, but those are just the facts. Even with a bankruptcy or foreclosure, it doesn't stop you from qualifying for an FHA loan. Like I said, they have some pretty loose qualifications. You can have a lower credit score, and they only require a 3.5% down payment. So someone can get into an FHA loan on a $200,000 house with as little as $7,000 down. You will have PMI on an FHA loan, and that is going to lower your cash flow. So be aware of that. You can figure if the loan amount's 200,000 and it's a 360-month amortization at 4%, what your payment will be. But don't forget to factor in PMI, and that can be $150 a month, so it will impact your cash flow. FHA loans are about 9% of the market, which means you look at 100 properties, you're probably going to find 9 or 10 of them are FHA financing. Can you take over them subject to? Absolutely, you can. And we've taken a ton of FHA loans subject to. There's no greater chance of a due on sale issue. They're just backed by the government, and that just means if the payer stops paying, that the government is going to come in and bail that lender out. So the next one is VA loans. Now, VAs have always been some of my favorite for a couple of reasons. VA loans are loans that are made to veterans or active duty military. That's your qualification for them. They are guaranteed to the lender by the Department of the VA. And then, of course, the loan is issued by a bank or credit union. They typically do not require down payment. So it's not unusual, especially in a flat market or low appreciation market. If someone gets transferred to a new area, they go out, they buy a house with a VA loan, they pay $200,000 for the house, you'll see that they took out a loan for $210,000. They'll let you roll closing cost in and everything else. So it's not uncommon to see a loan balance of greater than the purchase price of the house. Most sellers we find don't understand how VA loans work. A common objection that you'll get from people with a VA loan is, well, I want to use my VA entitlement to buy my next house, and if I leave this loan in place, I won't be able to do that. But that's not true. Your allowance as far as VA financing isn't based on the number of loans. It's based on your total amount of entitlement. And most VA entitlements across the country right now are $500,000-$600,000. So if you're buying a house from someone with a VA loan that, let's say, is in Arkansas and the loan balance is $250,000, they've probably got another $250,000 or $300,000 in available VA entitlement. So if their next house is that amount or less, they can get another loan. It's not an issue. So that's an important piece of information to have when you're dealing with someone that has VA financing in place. If that's their objection, then you can remove that objection pretty easily. VA loans are great because you can go into a market where there's heavy VA amount of VA loans, or where there's a base and a lot of people coming in that buy a home and get transferred out the next year or two. They don't have any equity. They can't afford to pay a realtor. So they try to sell the home themselves. If they can't before they have to move, a lot of times their alternative is just to rent that house out. So they become long distance landlords almost by accident. And you can come in, take over the payments, even with full financing, and still make money on that. So VAs are a very good type of loan to target. The next loan that you'll run into is USDA loans. And not a lot of people have heard of these. These are 100% financed home loans. The program was actually designed to promote home ownership in less dense communities with populations of 20,000 or less, outlying areas away from big cities, to encourage home ownership in those areas. They can finance 100% of the purchase price of the house. It's backed by the USDA. It's unique in that the borrower and the home each have to qualify. Now, the borrower has to qualify based on credit qualifications and income qualifications, but the home also has to qualify given the location, the value of the home, and some other things. It must be the homeowner's primary residence. That has to be it can't be a vacation home or a second house. When I say they have to qualify by income specifications, it's a little bit unusual. They can't make more than 115% of the area median income. So if the area median income is $100,000, or let's just say it's $50,000, that's more in line with the country. If the area median income is $50,000, they can't make more than $57,500 and qualify for a USDA loan. They can't be high income and do this. This is, like I said, primarily rural areas with middle to lower income people. Can you take a USDA loan subject to? Yes, you can. And we have a student that loves them and has several. I don't like them for this reason. When the first USDA loan I ran into, we thought we were able to verify the mortgage balance and everything else, but a USDA loan has a unique feature, unlike any other loan that you'll run into. It's a recapture feature, and it's based on one of a couple of different things. They consider USDA loans subsidized loans because they let you finance 100% and some other factors. When you go to sell a USDA property, they recalculate the subsidy, and they either make you repay the full amount of the subsidy or up to 50% of the property's appreciation during the time the homeowner has owned it. And it's the lesser of the two, but it still can be a complicated figure to come up with. So for the reason that it's just hard to really nail down that sort of thing, we tend to look at them and say, well, that's just not something I want to get into. But they can take up to 50% of the property's appreciation. So that's just something to know. You may think you're going in on something that's got a good bit of equity, but find out when it really comes down to selling it that the equity is only half there that you thought was there. So that's something to take into consideration. They're not a large percentage of the loans you're going to run into. Personally, I've probably only run into a handful of them during 20 years of doing this, but they are out there. And if you operate in the more rural areas, you probably will run into those. The last one that we're going to talk about today is reverse mortgages. Reverse mortgages are mortgages that seniors age 62 and older are eligible for. They allow the homeowner to convert equity in the property into cash or cash flow or cash payments that they can live on during their retirement years. It allows the homeowner to access their equity in their property without having to give up their home. So that's attractive to people who have lived in a home for a long time. Maybe they've paid it off. They want to spend their final years in their house, but they need to subsidize their Social Security, or they don't have enough retirement. There are some very, very strict rules regarding reverse mortgages and the fact that the homeowner has to maintain residency in that house. And they will do regular inspections to ensure that's being done. I'm telling you, they will send a field inspector out at least once a year, sometimes twice a year, to make sure that that homeowner is still occupying that property. And I've had this discussion with other investors saying we take reverse mortgages subject to all the time. Well, for me, that would present a problem because, well, first of all, you may get away with it as a landlord if you're going to have a tenant in the property. But if you're going to keep that thing for any period of time, it's going to involve some deception on somebody's part. Now, you're either going to have to tell your tenant to lie basically to the field inspector when they come by. If you sell houses with seller financing like we do, you're going to have to tell or disclose to your buyer what's going on, and they can't let anybody that comes by know that Joe and Sally don't still live here, which would probably make any buyer that's giving you a substantial down payment question, your honesty, your integrity. I just don't see a good way of buying reverse mortgages if you intend to hold them for 12 months or longer. Now, if you're buying a reverse mortgage property that has equity and your intent is to do a quick flip, maybe you're in a high appreciation market right now, or it is a house that still has substantial equity, would that work? Probably. That would be the only case where I would be willing to do that. But for a typical landlord type situation, a buy and hold, or to sell with seller financing when your end buyer may or may not refinance you out within a specific period of time, Would I be willing to do that? No. Reverse mortgages are probably the only mortgage that I absolutely would not take subject to unless my intent was to flip very quickly. USDA's most likely not. The rest of them are all okay. We've been doing this for 22 years and I've never had a loan call due. And we've done every type under the sun except USDA and reverse. But VA, FHA, conventional, subprime, if it makes sense, we've done them all. And I don't think, as long as you take care of two things properly, that's make the payments and take care of the insurance like you should, I don't think you're going to have any issues. So those are my thoughts on which loans are good for subject to, which aren't. You do you, whatever works for you, that's fine. But in my experience, this is the way to go. So hope this helps. Appreciate you guys watching today. Make sure you subscribe to our YouTube channel. We deliver podcast, our weekly live Goat Talk, and some other tips and things throughout the week. So we'd love to have you join us. So appreciate you being here today. Until next time, talk to some sellers and buy some houses.